Welcome back to the Florida Veterans Real Estate Podcast. I'm Darian, and today we are addressing the silent financial anchor, the hidden costs that can kill your VA loan eligibility and drain your cash flow, CDD and HOA fees. In Florida, especially in the beautiful brand new spec home communities we target, you will almost always encounter these two entities. Many veterans see the resort-style pool, the gated entrance, and the perfectly manicured lawns and think, this is the good life. And it is, but that lifestyle comes with a price tag, one that is not always transparent. Here is the danger. If you find a home that fits your monthly principal, interest, tax, and insurance (PITI) budget, but you forget to factor in a $400 combined CDD and HOA fee, you could instantly be disqualified from your VA loan. These fees are treated as monthly debt. They are non-negotiable and non-optional. We are going to give you the field manual to decode these fees. You will learn the difference between an HOA, which manages your neighbor's lawn, and a CDD, which is essentially a second temporary tax on your land. You will learn how to accurately calculate both into your VA loan debt-to-income, DTI ratio, and the secret to paying off the most expensive part of a CDD fee early. Today, you will learn the CDD versus HOA separation, why one is an annual tax and the other is a monthly debt. The VA loan DTI trap, how these fees instantly elevate your risk profile with a lender. The bond payoff strategy, the military precision move to eliminate the most crushing CDD debt. The cost-benefit analysis, how to determine if the resort lifestyle is truly worth the price for your wealth-building mission. This is critical intelligence. Let's start the mission brief and neutralize the silent financial anchor. The biggest mistake a veteran makes in the Florida housing market is confusing a CDD with an HOA. They are fundamentally different, and the financial implications of a CDD are far more significant. 1. The Homeowners Association, HOA. The rule enforcer. What it is. A private, non-profit organization governing the community. What it covers. Maintenance of common areas, pools, clubhouses, landscaping of entrances, community events, and enforcing the community covenants and restrictions. What color you can paint your house, what type of fence you can have. How it is paid, a monthly, quarterly, or annual fee paid directly to the HOA. The VA loan impact. This is counted by your lender as a recurring monthly debt payment, which directly raises your DTI ratio. 2. The Community Development District, CDD, the silent government. What it is. A special purpose local government entity established under Florida statutes designed to finance infrastructure for new communities. What it covers. The initial multi-million-dollar costs for roads, sidewalks, water and sewer systems, massive community pools, and other major amenities. How it is paid. A special assessment that is collected as part of your annual property tax bill. The total CDD fee has two parts. 3. The bond debt portion, a fixed amount paid over a long term, typically 20, 30 years, to pay off the developer's infrastructure bond. This is the anchor. 4. The operations and maintenance, O&M, portion, an amount that can fluctuate annually to cover the ongoing upkeep of the amenities and infrastructure. The VA loan impact. Because it is included in your property tax bill, the lender views the entire annual CDD fee as part of your monthly escrow payment, meaning it instantly increases your required monthly housing cost, the PITI component. In short, an HOA is a private fee for upkeep and rules. A CDD is a long-term debt obligation that is guaranteed by the property itself and is collected like a tax. Failing to budget for the CDD is the fastest way to get disqualified from a VA loan, especially for high-value properties in Florida's new resort-style communities. The VA loan is powerful because it allows a high DTI ratio, but CDD and HOA fees are one of the silent killers of that DTI advantage. The DTI calculation. Your DTI is the percentage of your gross monthly income that goes toward your total monthly debt payments. DTI equals gross monthly debt divided by gross monthly income. For a VA loan, the general guideline is a 41% DTI. While exceptions can be made with strong residual income, a good specialist lender wants to keep you under 41%. The PTI plus HOA plus CDD formula. When a VA loan officer calculates your new housing payment, they don't just use PITI, principal, interest, taxes, insurance. They use the PITI plus HOA plus CDD. 1. Principal and interest, P&I, the payment on your mortgage itself. 2. Taxes, T, your annual county property taxes, plus the full annual CDD fee divided by 12. 3. Insurance, I, homeowner's insurance, HOI, and mandatory Florida flood insurance, if required, divided by 12. 4. HOA condo fees, HOA, the standard monthly HOA fee. Imagine you find a beautiful home where the P&I is $2,200. Your taxes and insurance are $500. Your monthly payment is $2,700. That's manageable. Now add the fees. Annual CDD fee, $3,600, $300 per month. Monthly HOA fee, $150. New total monthly housing debt, $2,700 plus $300 plus $150 equals $3,150. That extra $450 per month of non-negotiable debt can easily push a veteran with a spouse and car payment past the critical 41% DTI threshold. The force protection. You need to get the full annual CDD and HOA fees from your realtor before your lender runs your pre-approval. This allows your VA specialist to accurately underwrite the file from day one, rather than having the deal blown up by a surprise fee during underwriting. Never look at the base property tax. Always look for the total annual assessment line on the tax statement to include the full CDD debt. The CDD fee is a financial anchor, but there is a way to cut the rope. The single most expensive part of the CDD is the bond debt portion, the fixed long-term payment to retire the infrastructure loans. This usually makes up the majority of the annual fee. The bond payoff strategy. The CDD bond portion is typically set for 20 to 30 years, but you can usually pay it off in full early. The upside, financial leverage. By paying off the bond portion, e.g., a one-time payment of $20,000 to $40,000, you permanently eliminate the largest component of your annual CDD assessment. If your annual CDD was $3,600, $2,500 bond plus $1,100 O&M, paying the bond leaves you with only the $1,100 O&M portion. This instantly reduces your monthly DTI burden by approximately $208, $2,500 divided by 12, improving your cash flow and freeing up DTI space for future investments. The upside, equity appreciation. A home with the CDD bond paid off is significantly more attractive to the next buyer, often leading to a faster sale and a higher list price. It removes a major psychological hurdle for the general home buyer. How to execute. This is a cash transaction, often handled through the title company at closing or directly with the CDD board after closing. When to use it? If you have a large pool of cash from a tax-exempt military severance, a retirement account distribution, or a large profit from the sale of your previous home, using a portion of that cash to eliminate the CDD bond is a high-yield, low-risk financial move. It is one of the few debts you can prepay to gain a substantial guaranteed return in monthly savings and future appreciation. Most financial advisors would emphasize that eliminating bad debt is step one of wealth building. The CDD bond is the definition of a bad debt you can surgically remove. While new communities offer great amenities, the CDD structure can be a complex machine designed by the developer. Here are the red flags to watch out for to protect your financial position. Red flag 1, the misleading low tax. Pitch. A builder or realtor might say, "The county property tax rate is very low here. This is a head fake. The CDD is not the county property tax, but it is collected on the same bill." Protection. Always ask for the total annual assessment, tax plus CDD. If the difference between the base property tax and the total tax bill is high, the CDD debt is high. Red flag 1, the misleading low tax pitch. A builder or realtor might say, the county property tax rate is very low here. This is a head fake. The CDD is not the county property tax, but it is collected on the same bill. Protection. Always ask for the total annual assessment, tax plus CDD. If the difference between the base property tax and the total tax bill is high, the CDD debt is high. Protection. Review the last 3 years of the CDD's financial statements. If the O&M portion is constantly increasing by 5 to 10% per year, you can expect continued budget pressure, which will hit your monthly escrow payment. Red flag 3, limited homeowner control. In the early years of a CDD, the board is typically composed of developer-appointed members. This means the board votes on budgets, new infrastructure, and new debt, and O&M costs that serve the developer's goals, not necessarily the homeowners. Protection. Inquire about when control of the CDD board is scheduled to transfer to the homeowners. This transfer usually occurs after a certain number of homes are sold or a set number of years have passed. Look for communities where control has already transferred, giving you a voting voice on the budget. Red flag 4, double-dipping HOA and CDD. In some communities, you pay a high CDD for infrastructure and a high HOA for amenities. The roles become blurred. Protection. Ask for a detailed breakdown of what each fee covers. A highly functional CDD should cover most common area maintenance, which should keep the separate HOA fee low, e.g., under $100 a month. If both are high, you are likely overpaying for redundant services. This entire episode comes down to a fundamental question for a veteran focused on financial independence. Is the resort-style living worth the cost to your DTI and cash flow? New construction communities with CDD and HOA fees provide a highly desirable, low-maintenance lifestyle. Pro, consistent, high-quality maintenance and aesthetic standards that protect your property value. Properties in well-managed CDD communities often appreciate faster than comparable homes in non-CDD areas. However, the cost must be measured against your military financial goals. Con, the fees are mandatory debt and can significantly reduce the size of the home you qualify for with your VA loan. That smaller loan today means slower equity growth tomorrow. Con, limited cash flow. If you plan to deploy the home as a rental via the Stepping Stone Strategy, Episode 6, that $450 a month fee directly reduces your rental profit, cap rate, and makes the property a less attractive investment long-term. The strategic decision. If you are buying a stepping stone or spec home for a 3 to 5 year investment period, you must be surgical. Look for properties where 1. The CDD bond portion is very low or has already been paid down by the developer/previous owner. 2. The rental market demand in that area is so high that the high-end amenities command a significantly higher rent, thus justifying the fees. The final decision is yours, but you must make it with full financial transparency. Never let a realtor or a builder use the sizzle of the pool to hide the price of the CDD fee. Find out the total monthly debt, plug it into your DTI calculation, and decide if you can still hit your target loan amount and profit margin. That is the definition of a financially successful mission. That concludes our mission brief on decoding the silent financial anchor, CDD and HOA fees. Here's the after-action report. CDD is a tax, HOA is a fee. Both are treated as debt by your VA lender. Calculate PITI plus fees. Your total monthly housing payment is PITI plus HOA plus annual CDD divided by 12. This is the number that your VA loan officer must use to run your DTI. Eliminate the bond. Use the bond payoff strategy to surgically remove the most expensive part of the CDD debt, instantly improving your cash flow and making your home more marketable. If you are currently looking at new construction in Florida and need help instantly calculating the true impact of CDD and HOA fees on your VA loan pre-approval, you need to find yourself a CDD/HOA DTI calculator spreadsheet. These tool allows you to plug in your income and the annual fees, and it instantly shows you the maximum home price you can afford while staying under the 41% DTI threshold. Thank you for tuning into the Florida Veterans Real Estate Podcast. Remember, everything you want is on the other side of fear.